Amazon has been one of the worst performing Mag 7 companies this year, and they have basically returned nothing in terms of their stock price. This is based around concerns around their AI strategy and their AWS growth rates. So what's going on with Amazon? As you know, it's a big portion of the public account. It accounts for about 16 to 17% of the public portfolio weight. I have around 140, 145 shares of Amazon, and it is a huge portion of my public portfolio and my thesis for long-term, high compounding growth companies. As I've mentioned in other videos, other companies in the public portfolio like Warrior Met Coal and Google have been doing extremely well. Google in particular has gone up over 30% since the start of this year on strong AI growth, on strong GCP growth. So I think Amazon is going to do extremely well over the next 5 to 10 years and beyond. So in this video, I'm going to go through a few reasons why I believe that Amazon is going to be an amazing long-term investment for years to come. So if you like this content, please like and subscribe. It really helps my channel grow. Now, as I said, they have returned basically nothing for the past year and even had a significant dip like all other stocks around April when the tariff rollout happened with the administration. Now, if we get into this Market Watch article that I found, Amazon stock is now big tech's biggest loser in 2025 as the cloud race heats up. So let's go through this article, and says that Magnificent Seven has been the dominant force in markets this year, but Amazon didn't get the memo. They've only returned 0.6%, and it's actually less now this year, largely due to investor concerns about the company's AWS business and its artificial intelligence strategy. Investors have expressed frustration with Amazon's lack of clear AI roadmap. Instead of beating the analysts' expectations, they only matched the 17.5% growth rate for AWS. So where does that leave Amazon? So let's look at TradingView and look at some of the Mag 7 charts to see what other Mag 7s are doing. Here's Amazon at actually negative 0.6% for the year to date. Let's look at Tesla. Tesla is up around 15%. Nvidia is up 35.5%. Microsoft is up 21.8%. Meta is up 23%. And Google is up 26%. So this is why investors are turning their attention to Amazon, because they feel that it's been left behind. So let's look at the reasons why I believe Amazon is going to be an amazing long-term investment. Now, to start, you can see that AWS revenue has been nothing but steady. It's been going up and to the right. This is because AWS is the largest cloud platform out there. It beats competitors like Microsoft Azure. It beats Google Cloud Platform in terms of market scale, in terms of number of customers, in terms of the revenue that it generates. And you can see in Q1 2025, they did $111.786 billion in revenue from AWS. And then in Q2 2025, it was even higher. Amazon has over 4 million customers in their customer base for AWS. So it is well diversified and not just relying on certain customers going from on-premise to cloud. It is a well-diversified customer base that will continue to provide this steady growth in revenue and become a larger and larger portion of their total revenue generated from this company. But this is just one point of why I think Amazon is going to keep doing well in the future. This is speaking to the software portion of their business. AWS, the first mover, the biggest and largest cloud platform, and steady and diversified customer base. That's just number one. They are moving into hardware now too. So here you can see that they're making even further deeper collaborations and investments into Anthropic. They're investing additional $4 billion into Anthropic to train and deploy its largest foundational models. The announcement was underpinned by the rapid adoption of Claude family of models on AWS, following its addition to Amazon Bedrock in April of last year. And Amazon is heavily invested into Anthropic, and that's basically their competition to Microsoft Azure and OpenAI. Google and Google Gemini. Anthropic has now mentioned that AWS is their primary training partner, in addition to continuing to be its primary cloud provider. And so we'll use AWS Trainium and Inferentia chips to train and deploy its future foundational models. Both companies will continue to work closely to keep advancing Trainium's hardware and software capabilities. The response from AWS customers who are developing generative AI applications powered by Anthropic in Amazon Bedrock has been remarkable. And if you're wondering what Amazon Bedrock is, it's basically a comprehensive, secure, and flexible service for building generative AI applications and agents. So Amazon has made this service, has developed the Inferentia and Trainium chips, and has partnered with Anthropic, which is now valued at $190 billion. And all of this together is competing with the Microsoft Azures and OpenAIs and Google Geminis of the world. And this type of collaboration and investment is helping Anthropic to develop faster and better models. So here you can see that Anthropic has launched Claude Sonnet 4.5, its latest AI model that's more of a colleague. It's getting more into that agentic space. So you can see that it's better at coding, using computers, and meeting practical business needs. The Amazon-backed startup is valued at $183 billion and competes directly with OpenAI. Anthropic said Claude Sonnet is the best coding model in the world. So other businesses can take this Amazon-backed startup software and replace entire teams of coders because it can do this work for them. If it can code for 30 hours straight without taking breaks, without asking for pay raises, without sleeping, it can replace teams of coders. So this is what Amazon does. Amazon's business model is centered around making something great for themselves. They build and scale and make it better for themselves, and then they sell it to customers and other businesses. So based on this, I think there's going to be a re-acceleration of growth in AWS, which is one of the prime concerns around Amazon's AWS cloud platform. So what's the next piece of the puzzle? Well, the next piece of the puzzle is robots and automation. Now, Amazon is already using a lot of robots and automation to support their employees and their operations to make them more streamlined and efficient. And you can see that Amazon has deployed its 1 millionth robot in operations. It's a new generative AI foundation model that will improve robot fleet travel efficiency by 10%. Technology advances support faster delivery times and lower costs to consumers and customers. And over 700,000 of their employees have been upskilled through training programs that prepare its workforce for the future. Now, the reason this is very, very critical is because the retail side of Amazon's business, the logistics, the retail, all of that is a lower margin business compared to AWS, advertising, things like that. Because there's just so much more overhead, there's so many more employees, it's just a lower margin business. But what they can do is they can get robots and AI automation to supplant, to remove a lot of that workforce, to streamline logistics, their delivery, their operations going forward. And that makes a low margin business a higher margin business. And then you just have all around Amazon a high margin business. Every segment is a high margin business. And that will be a game changer in the stock price and the company's financials. Now, I talked about advertising, and advertising is another pillar of why I think Amazon is going to be doing so well over the next few years. Here, you can see that Amazon's advertising business hit a milestone in the second quarter of 2025, capturing 9.36% of the company's total revenues, the highest share ever recorded, and rose 23% year over year to $15.69 billion, representing 9.36% of total revenues. This momentum reflects the impact of AI-powered optimization a growing share of the digital advertising market, and Amazon's ability to harness its vast retail media presence, proprietary shopping data, and expanding connected TV, CTV, footprint. The global rollout of Prime Video adds a high-value premium channel that could further lift revenues. So traditionally, they were advertising on the e-commerce side, in the retail e-commerce side on Amazon.com, but now they're adding ads to Amazon Prime Video, and that just opens up a whole new can of revenue generation for this segment. And advertising, as you know, as I've talked about, Meta's and various other companies' advertising businesses, they're always a high margin business. Google and other companies that advertise, Google and Meta, those have recurring year-over-year revenue generation from advertising. So Amazon is now growing in that space, and I think they're going to do really well in that space with all of this proprietary data, with this retail media presence, with everything they mentioned in this article. They're poised to take advantage of all of that advertising spend. Digital advertising fuels Amazon's top line in two ways. It directly generates revenues from brands paying for sponsored placements, display and video ads, while also boosting product visibility and retail transactions, which in turn drives sales and third-party seller fees. That's an insane flywheel. You basically are covering all parts of the advertising business. And since it's a high margin business, a lot of that top line revenue, money, cash flows straight to the bottom line, because you don't have anything in the middle, much in the middle, to take up the expenses, to take out the costs. There's not that much of it in a high margin business, because that's why it's a high margin business. Here you can see all the different paths that you can put Amazon's ads through. At 300 million ad-supported users in the United States alone, spanning retail, Prime Video, Twitch, Fire TV, and live sports like the NFL, NASCAR, and NBA deepen their engagement with Amazon. With the landmark Roku partnership grants advertisers exclusive access to 80 million CTV households, the largest authenticated footprint in the United States, via Amazon DSP. Like I said, Google and Meta are the kings in this space, but Google and Meta have been doing this for years and years and years. They've been growing every year. So I don't see why Amazon can't do the same thing. If they had Q2 revenues of $15.69 billion, I don't see why they can't just keep growing that quarter over quarter, year over year. In advertising, I mentioned Prime and Prime Video. So there's so much more to Prime subscription benefits that it's good to go through these benefits and see how customers get locked into using these products. So with a subscription, free and fast delivery from the e-commerce side of Amazon, Prime members get entertainment benefits like Prime Video, Amazon Music. Prime members get access over 100 million songs in shuffle mode, all access playlists, plus the largest catalog of top ad-free podcasts included with their membership. So they're competing with Spotify there. Prime Video competes with YouTube, with Netflix, with all of these other companies. Amazon Music Unlimited, Prime Gaming, you get free games each month and free channel subscription to Twitch TV. Amazon Photos, Amazon Kids Plus, Kindle Books, Audible narration, free titles at Audible. There's a whole list of benefits for sticking with Amazon Prime membership. So there's so much to lock people in, and they just keep adding services to this that really make it worthwhile to continue holding that subscription. And that's more steady revenue for Amazon. And the last piece of this puzzle, why I think Amazon is such a long-term investment, is because of their logistics business. They are like a bunch of logistics and delivery companies put together. They're that massive. See, they continue to add scale to that. This article talks about Amazon offering fulfillment options for Shein, Shopify, and Walmart. And some of these are competitors in their e-commerce retail space, but they're still offering that fulfillment and kind of becoming this all-encompassing logistics network. And now some of these popular e-commerce channels like Shopify, Shein, Walmart, they're integrating with them too to capture as much as possible. in terms of revenue generation and customer base scaling. With that, let's go through the valuation of this company and see what they look like. So I pulled it up in the stock valuation software here, and their PE ratio trailing 12 month is 33.56. They are for a PE of 28.25, which means that there's possibility of earnings growth in the future. Their analyst price target for 1 year out is 265, which is higher than the current price of around 220. I've reorganized this so that you can get a clear, clean-cut representation of the numbers very quickly. And so here you can see their revenue is just skyrocketing. It's just up and to the right, exponentially. You can see their net income minus the 2022 negative net income there has been going up. EBITDA has been going up. And this net income, there's multiple reasons for that. The EPS is going up. You can see that the balance sheet and the shares outstanding, they do have some stock-based compensation. Their shares are increasing even though they're buying some shares back. Free cash flow, 2021 and 2022, negative free cash flow, but overall increasing. It's not as big as, Microsoft or Google or Meta, because Amazon reinvests so much money back into capital expenditures and reinvestments into the company. So moving to valuation, here you can see that given a 20% revenue growth in 2027, 2028, and 2029, if we see, AWS reaccelerate their revenue growth and some of the other things that I mentioned reaccelerate the overall total revenue growth, we can get a price tag of 261 to 265 based on the analyst estimates for this company. And I wouldn't be surprised if they beat on some of these growth rates and maybe even got even ahead of this number. I think in the next few years, they could definitely go even past that. And moving on to the multiple of earnings valuation, here you can see that given maybe a 16, 18, 20% net income growth, keeping the PE the same, which should change, but you get similar numbers. But for 2028, 2029, you can see that it's crossed over $300 per share. Analyst forward estimate is 265. See that the current price to earnings is 33.6, around that level since maybe the lows of April this year. And then before that, it was much higher. So it's come down nicely and getting more and more favorable as time goes on. You can see revenue is projected to increase. Cash flow projected to increase. They're beating, for the most part, on analyst estimates for their EPS. So overall, this is an amazing company. This is an amazing investment for the future, I believe, in my opinion. And what am I doing? I have started DCAing more into Amazon. I recently made a purchase of some shares in Amazon. Now, I am working on something to show the moves that I make, the buys and the sells that I make. I'm going to make something on my website to display that to members of my channel going forward. So that's it, guys. Thank you for sticking with me through this video. If you like this, please like and subscribe. It really helps my channel. And I'll see you guys in the next one.